Well, thanks for showing up, guys, because this might come as a little bit of a surprise, or not, but we're going to do something different here. I know that most of the presenters you've seen so far over the past 2 days, they obviously come from the gold industry in particular. And as you would have noticed from the introduction, I do not come from the gold industry. I proudly started a business 2 decades ago. We are one of the few truly independent finance online media companies in Australia. And we do not particularly focus in on gold or precious metals. We do investing in general. And of course, gold, investing in bullion is part of that. Let me see whether everything is working here. One of the question marks, I'm also on Twitter. And one of the question marks that keeps on coming back on my Twitter feed over the past year or so, maybe a little bit longer. And even this morning, I had to formulate an answer to one of the Twitterers with the same question. And the question is, why is gold not performing? And I know there are different views about what actually is performing. But on my observation, most investors over the past year or so that were positioned for a rally in gold stocks or in gold bullion, they've been left wanting. It sort of hasn't happened. I mean, if I take a little of a broader view, gold in US dollars has sort of fluctuated between 1700 and 1900 over the period, and most people were expecting a lot more. And a lot more expectations will obviously build on the fact of two narratives that usually support gold. Teller, I'm on stage. One of the narratives is that you buy gold as a safe haven in terms of geopolitical unrest, and that is probably one of the reasons why gold is supported here. The other narrative is that gold is a hedge against inflation. Now that narrative is a bit of a problem, because in the 1990s we had inflation, and yet gold kept on falling in price. And by 1999, I would have been, when gold hit about 250 US, coming from 830 in the early 80s, I would have doubted whether there were too many investors still wanting to have a lot of gold in their portfolio. Now in the 1970s, which is mentioned earlier, all of a sudden everyone wanted to be in gold. And the 1970s, of course, had runaway inflation and high bond yields. Now gold fluctuates between those two scenarios. And the answer is somewhere in the middle as to why gold hasn't performed this year. And I think I'm going to surprise a few of you, but I hope I can give you some answers today. Now, first of all, no financial advice. You have been warned, and I know you do. Let me start, because as I said at FNArena, we don't look particularly at gold in particular, but we take a broader view, and we start from financial markets. Now, let me start off by making you all a little bit happy if you're really, really into gold, because I believe that financial markets this year are in a bear market. And a bear market is not that uncommon in financial markets. We actually, on my analysis, we have them quite regularly. But bear markets sometimes can be quite mild, and sometimes they're not being recognized as being a bear market. Now, there is this lazy journalism rule that you're only in a bear market when assets are down by 20%. I find that very lazy, and I find that very incorrect. A bear market is when you go on your way to down 20%. It's not just at that cutoff point of 20%. But needless to say, usually gold performs quite well in bear markets. I mean, and it performed quite well in 2020. It performed quite well in 2008. And this bear market, which I believe it is, has a lot of the characteristics that we've seen in 2008, I believe, and definitely has the potential to be at least of that magnitude. But so far, we haven't seen gold perform in the same way. And as per always, I think the answer is not that difficult. The answer is US bond yields. But I'll come to that with a little bit more of an explanation. Apart from the fact that it's always difficult to define exactly when the bear market starts and how deep it will go, the discussion is always like, where do you put your starting point? I believe the starting point was at the very least in January this year, when the Federal Reserve indicated that they would not only go very hard on interest rates, but they would always also reverse the QE, the quantitative easing, and move to quantitative tightening. Now, even if you believe that that might be a little bit too strict on my behalf, I do believe that the early seeds of this year's bear market, they're already apparent in last year, a year ago. And if you, this gives you an idea of the type of service that we provide to investors. We try to paint them a broader picture, and at the very least, even if we are wrong, at the very least, we hope we can give explanation to investors. Now, one of the things that started happening in early 2021 is that first, the very highly speculative elements in the share market started tripping over in the US. And subsequently, it moved on to microcaps. And then it moved on to small caps. And then it moved on to mid caps. And the next thing that happened were the speculative elements in the cryptocurrency space, the NFTs. They started tripping over. Next thing happens, the cryptocurrencies themselves. Next thing happens, technology companies. Next step, the large technology companies. Recently, we've seen the financials tripping over in Australia. I believe, my theory is, and this is a very strong scenario that we also saw in 2008, I have a theory that bear markets these days develop like domino stones that one trips over the other. So it's only waiting for the next domino stones to fall, in my view. And this is going to surprise you. I believe that one of the domino stones that is going to trip over the next few months is gold. But we'll come to that. To back up my theory a little bit, this is the S&P 500 in the United States. Largest companies are in there. And the other index is the Russell 2000, which, broadly speaking, translates to the mid-cap stocks in the United States. And you can see from mid-last year that both go separate ways. And this is what I just described, that while the large cap stocks were still marching on, already the small cap stocks, the mid cap stocks, they didn't follow anymore. They actually started falling quite a lot. At the very end, we get the technology stocks, and then all of a sudden, it impacts on the market as a whole. One of the things we do at FNArena, which we're very proud of as well, and I know these guys are not free of complaints and not free of. We amalgamate all the ratings from the major stockbrokers in the country, and we make that available to our subscribers. One of the advantages we have is because we have all the data, is that we can actually analyze the data. And for those who think that stockbrokers only put buy ratings on stocks, here's the evidence that is by no means the case. Admittedly, these are the sell ratings. They seldom come beyond 20%, but they usually are in single digits. Stockbrokers don't like to put sell ratings on stocks. But these are the ochre colored are the neutral ratings, and blue are the buy ratings. And what you clearly see is that the normal situation in the stock market is you have more neutral ratings than you have buy ratings. This is pre-GFC. This is a period here as well. But what you see is that when the bear market opens up in the market, we go to a majority of buy ratings. This is your GFC, this is Brexit, 2018. Look what happened in 2021. We are almost at an all-time high over the past 2 decades or so in the balance of buy ratings. This is one of the indicators that we use, and we say, listen guys, it's a bear market. What you will see now this year is that this is going to be put to the test, and the test will probably be negative. Too many companies will not be able to confirm their expectations. They will probably have to issue profit warnings leading into August. And in a few weeks' time, the US will have their Q3 reporting season, and I think we should be bracing for disappointment. Disappointment because of other reasons. Costs, inflation is impacting on margins. We had previously record high valuations, record high margins in the US. It doesn't bode well for the short term, and you see that now on a daily basis in the market. Now, still the question is unanswered. In this situation, why isn't gold performing better? As I said, I believe one of the next domino stones to fall is the gold sector. In Australia, very popular to stack up your portfolio with mining stocks and with energy stocks, inflation protection. That works up to a certain extent. But what you do have to realize is that as the bear market rolls on, the focus of investors is going to change. And at first, we all have a knee-jerk response, and we seek protection from inflation, and we do that through energy stocks and through mining stocks. The next focus will be on profit warnings of companies, and the focus after that will be about a recession. And I think it's almost a given that we will have recessions in the UK, in Europe, in emerging markets, potentially in China. Still a big question mark in the United States, but I think if the Federal Reserve has to ramp up its tightening, which is probably the case now, the odds for a recession in the US are obviously shortening quite quickly. Australia is very unlikely to have a recession, but the problem for us is if they have a recession elsewhere, we are not going to escape. I believe that a very fundamental event happened in mid-May. Jay Powell gave a presentation to the Wall Street Journal. In that presentation, he made it very, very clear that inflation is now #1 priority, #2 priority is inflation, and #3 priority is inflation. And I believe that the price action we've seen in the market since mid-May is with investors finally sinking in what that means for equity markets and for bond markets. We often refer to, and so does the head of the Federal Reserve in the US, we often refer to Volcker in the early 80s, who gets the reputation of he killed off hyperinflation or high inflation. What is usually not mentioned with that is that happened only after the US suffered back-to-back recessions in 3 years. And that is the way how you kill off inflation. I believe that the Fed at this point in time has very little alternative other than to go hard on interest rates. And because the only reason is that they have to bring, the only way that you kill off inflation is you bring supply and demand back in balance. Now, we have a problem on the supply side. It's not working on the supply side. So we have to kill off the demand side. And that may or may not be, at the very least, an inflation scare. Now let's step away from financial markets for the time being, and we're going to gold. One of the wonderful things about gold, and I totally agree with it. I have gold in my portfolio, by the way, but I treat gold a little bit different from most other people. For me, it's an insurance policy. And why do I treat gold like an insurance policy, and why do I like gold as an exposure in the portfolio? Is because of this. This is an overview of how gold has performed in each calendar year since the year 2000. And if I take you just to the main conclusions at the bottom, the returns, even in Aussie dollar or in euros, and this is in US dollars, the returns are pretty similar to what you get from the equity market on average. It's between that 9-10-ish percentage. Yes, there are no dividends, but that's what you get. The advantage, however, is that on occasion, gold doesn't move in lockstep with the equity market. It actually does the opposite. So in some of the years when the equity market is very positive, gold actually doesn't perform, and vice versa. And see, I'm interested in the vice versa. Where I have gold in my portfolio because I know when the time comes that the equity market does not perform, then I hope that my gold kicks in under the right circumstances. And this year, under the right circumstances, is that while other assets are falling quite hard, including cryptocurrencies, gold is not falling hard. And see, while a lot of people on my Twitter feed are disappointed because gold is not rallying to 2.5 or 3,000 US, I'm actually quite not that unhappy because all the equities I have, they are falling. I am very much of the principle that when I move in a bear market, I try to reduce my risk. And one of the ways is that I like exposure to bullion, not necessarily to producers. And why is that? Because if you take on a producer, you take on specific company risk. And bullion is just bullion. There's less risk. However, I can fully understand why people go for producers. And one of the reasons is perfectly illustrated on this chart. And I can easily explain it to you. The goldish colored line, that's your bullion, and the blue one is a international index of gold producers. And what you see is that when gold is popular, then we push up the producers much higher than we do with bullion. In other words, your return is higher from the producers than from bullion. But there's the other scenario. When gold is not that popular, you will find that producers fall much deeper and they trade at a discount. So you get higher profits and you get higher losses. See, for me to smooth that out, I'll just stay with bullion. But if you can figure out when gold gets popular, you can get higher returns through playing the producers. There's another strategy, and it's very specific to gold. See, usually what happens with the small cap mining companies is that, in particular, when you go for the more popular speculative ones, think uranium, think lithium, rare earths, is that usually it's in the company's benefit to not produce anything because you get massive share price runs and all they have to do is to exist and every once in a while to issue a statement to the ASX from we drilled a few holes. Now, the theory has always been that gold producers are different. So in gold's case, the big returns come when a gold company actually starts producing. And this is a little bit of a snippet from research done by the analysts at Canaccord Genuity, partly Canadian, but they are present in Australia. And they put the theory to the test. And what happens if you put a theory to the test? You always find out it's not quite 100% the case. So what the analysts have found, that if these are the assets, and these are the returns you see after they start producing. And what you find is that, yes, in some cases you make a humongous profit. This is 152%. But in some cases you can also go down by 83%. So it's not such a clear case. And so the theory holds that you buy a gold producer from the moment it starts producing on the premise that it delivers on expectations. It can't have difficulties along the way, because then the damage is almost, well, it's large enough to pay attention to. Now, it just so happens to be that this year we have 4 gold companies in that particular position, and I've put them here at the bottom. And from personal experience, I can tell you that in particular Red 5, I believe they are only weeks away from really starting production. And I pay attention to analysts who cover the share market, and I can tell you, anticipation is building among analysts. They're getting quite excited in advance. Of course, again, this is for those with a little bit more of a stomach for higher risk, and there's obviously no guarantees. I mean, if these guys run into problems, the share price will respond. I still haven't explained why gold hasn't performed this year, and why gold might be the next one to fall off a cliff. I'll have to do this very short, very briefly, because I'm assuming I'll leave a little bit of time for a question mark. But this is both an explanation of why we might be facing Armageddon and why gold hasn't performed. And the true story is official bond yields and corrected for inflation. So what you see in the 80s is that bond yields went very high, but inflation went much higher. So if you correct the official bond yield in the US for inflation, they actually went very, very negative. Now that's ideal for gold. That's when gold performs. That's why gold went from 35 US to 830. The problem is, of course, that if this draws back in, that's a negative for gold. This, I believe, if the central bankers achieve what they want to achieve, which is basically inflation up, bond yields up, interest rates up, and inflation coming down, you will see this narrowing, which is the reason for gold not to perform. This is why the enigma, I thought gold was an inflation hedge and then it falls in price. Yes, but this is the true master of gold, like it is for every other asset. It's not that simple though. There is a scenario, and this is some of the economists that abide by this chart. They will tell us it's already too late. Coming from this experience and going for this, they believe we are now facing a prolonged period of embedded high inflation because it already went too deep and we can't bed it in now. I'm not necessarily convinced that is true, but if that is true, you will want to have exposure to gold because gold will do a repeat of the late 1970s and the early 1980s. But unfortunately, I can't give you a guarantee that that will be the case, but it is a scenario that we should all keep in mind. By the way, if that scenario unfolds, you may want to reconsider your exposure to other assets like bonds and equities in general. If you like to know more about what I do and the stuff I publish, I actually think I'm a better writer than I'm an orator. You put secret behind the address of the website, and it's for free. And you can also get a trial with us. And 8 minutes left. I think that's at least room for 2 questions, I think. If there are questions.
Does anyone have down the back there?
Thanks for your presentation. Look, my question, I believe, is the elephant in the room question for precious metals.
Yeah.
Do you, the price of precious metals, so gold and silver, will only be allowed to rise as much as the criminal banking cartel and governments around the world allow it to rise? I mean, we've had numerous speakers here, and not one person has been prepared to address that question. And it's a fact. It's been going on for 45 years. People can bury their head in some sand. You can buy all the precious metals you want, but they will only be allowed to rise if the criminal cartels are gotten rid of. So sorry to ramble on.
No. It's fine.
What's your thoughts on that, please?
You'll be surprised. We as FNArena, we published a lot about that 10, 15 years ago. I think at the end there's definitely an element in there, but I also think too many people in the gold industry treat it too easily as an explanation of why gold. I could easily have said gold hasn't performed over the past 12 months because the evil bankers didn't want it to, but it's not true. I think the bond yields are your explanation. So it's used too easily as an explanation.
I would disagree completely.
Oh yeah, that's fine.
I would disagree with that.
And where I come from, that's what makes a market.
Because people, so financial advisors, people in the financial sector have got to be very careful what they say, because if they break rank, dare to challenge.
No conspiracy behind me. There's no Russians or Chinese behind me, I can guarantee you.
No, and look, I'm not saying there is. I'm not. Please don't take it that I'm having a go at you personally. But it's if you actually, or people take the time to look at the history of money and study what the mainstream financial media do not want to say, and it's been going for 45 years. So unless that changes, the price of precious metals is going to have a ceiling placed on it. I'm not saying it's going to go on forever, but so until that's fixed, there will not be true price discovery of precious metals.
Okay. I'll disagree with you on that one.
Well, so look, we live
That's
in a
fine.
democracy, but
That's
we'll,
fine.
we'll,
Yeah,
we'll
yeah.
agree to disagree.
That's what makes a market.
wholeheartedly.
Yes.
Thank you.
You have another question?
Yes.
Over long periods of time,
Yes.
gold does take care of inflation over long periods of time.
Yeah, well, I disagree with that one too, by the way. It's what makes a market.
We bought some houses in Chatsworth in 71. The price of gold in 71 was
Yeah, but it was controlled.
the
It was
price
controlled.
of gold at that time
Yes.
was about $71.
Yeah, but it was
I had
pretty
an
much was
argument
controlled.
with my son
Yeah.
a few months ago. Exactly what I said to you. Blah, blah, blah. So what we did was we took the price of the house in Chatswood. We worked out how many ounces of gold we paid for it in 1971. And it worked out that the house in Chatswood, which was then worth about 2.2 million or something like that, was worth 2.8 million in gold over the period since 1971.
Yeah,
round about.
yeah.
My wife made the observation, shit, she said. And she doesn't say that very often. Why did we do this? Why didn't we just buy the B gold? Because think of all those damn toilets I had to clean after tenants when they left. That's a bonus.
Yeah.
But
That's-
essentially,
I'll tell you why you didn't buy gold. Because in the 90s you would be crying in your room because gold wasn't doing anything in the whole 90s. Yeah. And
no,
that's
I'm
that's
talking
and that's the problem.
The
That's the
key
problem.
is long periods of time.
Yeah, but the thing with those theories is it always depends where you put your starting point and what is over time and what is a long time. All right? I mean, you're right because we just had and I'm not discussing. I just told you it has an equity-like return. Yeah, I just told you, so I agree with that one. But it's very irregular. All right, and if the bond market doesn't want, or the banks doesn't want gold to perform, then it doesn't perform. Yeah, so, and you can't live in it. So it depends on where your emphasis lies, so to speak, and the whole thing about it's an inflation protection. I've seen people turning that around and making calculations on the basis of 830, the peak of the 80s, then incorporating inflation in the bullion price, and then saying it should be worth $5,000 today. You go like, you guys are dreaming. What do you think? Newton has made a law that inflation automatically gets priced in. That's not how that works. Yeah? But when we do get high inflation, and I think gold is a very good protector against high inflation, which is a different animal from inflation. Exactly, not necessarily, exactly. It happens irregularly. So it depends on how you view it and how you treat it. Yes. Yes. And again, I use it as a insurance policy. I don't use it as I want it to evolve with inflation, because if I have a very well-performing industrial company, it beats inflation hand over fist, all right? Unless we go in the bear market, and we're now in the bear market. 1 minute and 33 seconds, darling. I think there's one more coming.
One more question? Got to make it quick.
Yeah.
Yes. One, do you see another Asian financial crisis with higher US interest rates and they won't be able to repay their debt? Second,
yeah.
the gold price and every other currency in the world bar the US dollar is at record prices.
That is true. It's a currency play in different countries. I agree with that one. Yes, absolutely. And in Australia, for example, you see gold doesn't actually move because the currency drops. First question, I don't know whether it's in Asia, but I'm waiting for the next shoe to drop, and it will at some point, I think. Yes. Might be a hedge fund, might be a country, might be crypto base. Thank you, guys.
All right, we're going to have to wrap it up there. Thanks, Rudi. That was fantastic. All right, our next presenter is Glenn Domer.